Essentially, successful trading is selling something for more money than you bought it for, where a trader at a local market might trade in fresh flowers. A financial trader does the same, only with financial instruments instead of produce.
So is that the only difference?
Yes, pretty much. A financial trader trades financial instruments. A flower trader trades flowers. However, I would be a terrible flower trader. I don't know the first thing about lilies or roses, like where to buy them, when they are in season, how long they last, and finally, who to sell them to.
Okay, I'm starting to understand this now, Philip. So as financial traders and investors, we really need to understand the product before we can even think about trading it.
Exactly. You've got it. So let's get started. A financial instrument has three broad layers that help define it. First of all financial instruments are contracts.
That makes sense. We know what contracts are. They're legally binding agreements.
Good. The second layer is whether it's a cash or derivative instrument.
Okay, you've just lost me.
Okay, don't worry. A cash instrument has its price determined directly by a market. Think back to our flower trader. When a customer buys a bunch of roses from him at his stall, they agree a price. That's what I mean by directly determined. A buyer and seller have come together, agreed the price they're both happy with, and exchange the item there and then. In finance, however, the scale is much larger, and the local markets are places like the stock exchanges or trading floors, but it's the same principle. Everyone with me so far? A derivatives price is determined by another asset or variable and not the derivative contract in and of itself. A derivatives price is indirectly determined. Think of it as being at least once removed from the underlying market. For a cash instrument, its price is derived, hence the name.
Can you explain that one more time?
The concept will become clearer as the course develops, but to give you another example, say we were sitting on a bench near the flower trader stall and we were watching the customer buy the roses.
I'm with you so far.
Okay, so if we were to place a wager on the actual price agreed between the flower trader and the customer, the agreement we made would be a derivative. The underlying asset are the roses, which we never own ourselves, and we have no influence over the price at which the flower trader and a customer transact.
Can you give us an example from finance?
Of course, spread bets, CFDs are derivative instruments, but don't panic. We'll be exploring these later in the module. For now, just get comfortable with the main difference between cash and derivative instruments.
Okay, got it. What's the third layer?
Instruments can be split into 4 asset classes: equities, foreign exchange, commodities, and debt. We'll discuss each one in detail during the rest of this lesson.
Great. It's starting to make sense.
Okay, one last point before we move on. There are lots of financial instruments out there. Many of them would be unknown to you unless you've worked for a bank or a hedge fund.
I have a friend who's a hedge fund manager.
Okay, well, most instruments aren't relevant to you as a private individual, as you are trading your own money. When you finish this course, you'll know which ones are relevant. But as a rule, if you don't know what it is, don't trade it.
Got it. What's next?
We are going to look at what equities are.